Is a $20 stock more expensive than a $10 stock? If you answer yes, it is more expensive, you would probably be wrong. The answer is it kind of depends. The stock price doesn't always match up well with how well a company is doing. Let me explain. Hey, what's up? It's Jeffrey Lin for Stock Sessions. Just as a disclaimer, as always, this video isn't for investment advice. I'm not a financial advisor. I'm not an investment advisor. I don't have any licenses. I'm not a broker. These are only for educational purposes only because you have to get educated. You have to understand how the stock market works, how to think like an investor. So this is what these videos are for. With that said, let's start at the very beginning of investing in stocks. And one of the things that people just kind of skip over at the very beginning, and they just start looking at what stocks they want to invest in. They're thinking about the company, but a stock doesn't always equal a company. So let's say we have an airline company, right? So this is the company. And over here, we have the stock. I know it's a roll of toilet paper. That's kind of what stocks are. They're just pieces of paper. They're not equal. They are not equal. It's more like they're sort of equal. But that's why a lot of times you'll see a company doing very well like this, and the stock will go like that. It's because these two are just sort of related. They're not exactly related. And one of the reasons for the stock price not necessarily matching the company performance is because the amount of shares can increase or decrease. Let's use this example of the airline company again, right? So let's say we have a couple of shares that we own. Let's say we own 2 shares. Each is worth $20, right? Sometimes they can do what's called a split, and suddenly you have 4 shares. Each is worth $10. So this one split into 2, and this one split into 2. So you have a stock split, right? But the company value didn't change. They just changed the number of shares that were out there. So did the company just become half expensive just because the shares are now $10 instead of $20 like it was before the split? No, the company value remained exactly the same. They just changed the number of shares. So if a stock price doesn't tell you if a company is cheap or expensive, then what does? Using multiples is a better way to compare how expensive one company's stock is to another. One of the most common multiples that investors would use as sort of like a back of an envelope, back of a napkin kind of a calculation would be, it's called a PE ratio, which stands for price per share divided by earnings per share. And this equals the multiple. So you take shares out of the equation and you just end up with price to earnings. So it's basically saying what's the price you would pay for each dollar of earnings that the company would earn. And looking here at the earnings per share, also known as the EPS, it makes sense because now you're looking at how much the company is making instead of just what the stock is doing. And how much the company is making is really important. Just sort of like each of our individual incomes are important to be able to pay our bills. Companies have to pay their bills. Companies have to pay their employees. Companies have to pay rent. Companies need to buy machinery to make products. So having a good earnings is important. And that's why every quarter, which is every 3 months, a company will announce its earnings to its investors. It's telling them how much they're making, how the company's doing. Obviously, earnings aren't the only measure of a company's health and its value, but it's a very good starting point to do that. All right, let's do a quick example. Let's say we're looking at two different companies. One is an airline, one is a cruise ship. They're both for travel, leisure, so they're kind of in the same industry. And let's say their airline company has a earnings per share equal to $10. The cruise ship has a earning per share of only $5. So the airline company, let's say the share price is $20 and the cruise ship is also $20. So their stock prices are exactly the same. Finding our PE multiple, you would get, for the airline, you would get $20 per share divided by $10 earnings, and you would get a multiple of 2. Now for the cruise ship, you get a PE multiple of 20 for the stock price divided by 5 for the earnings, and you get a 4 multiple. So the cruise ship is more expensive. And this one is cheaper. And it kind of makes sense, right? For the airlines, you're paying $20 and you're getting $10 in earnings. Meanwhile, for the cruise ship, you also pay $20, but you only get $5 of earnings from the company. So using this airline example, we can kind of show how the stock price kind of bounces around. Let's say the company's earnings are right here. So earnings per share here at $10, right? And the stock price kind of starts up here at $20. And because this airline is cheaper than the cruise ship, people might want to pay even more for it. So the price of the stock keeps going up, maybe to $30, while the earnings kind of stay the same. But even at $30, we have a multiple of 3. So it's still cheaper than the cruise ship, which had a multiple of 4. So this is what you call multiple expansion, where the stock price goes up even though the company's earnings isn't really going up with it. Multiples can also contract, where the company's still earning the same amount of money, but investors are just paying less for the stock. Let's look at two real-world examples. I have two of the biggest tech companies compared to each other. We have Apple here on the left, and we have Microsoft here on the right. So again, normally people think because Apple is at $284, it's more expensive than Microsoft at $171. But if you look down here at the ratios, this one for Apple is, here you have the earnings per share, and here you have the PE ratio. Apple's PE ratio, Apple's multiple is 22.5. So you're paying $22.5 for every dollar that Apple is making. Meanwhile, over here On the right, you have Microsoft's earnings. Microsoft is earning $5.74 per share, earnings per share, and its PE ratio, its multiple, is 29.94. So Apple is actually cheaper at these prices. Apple's multiple is 22.58, and for Microsoft, its multiple is 29.94. So in this comparison, Apple wins. I just want to note one thing here. You'll see there's a TTM after both the earnings per share and the PE ratio. So TTM stands for trailing months. Trailing 12 months means this is the EPS for the past 12 months. And also this is the PE ratio for the past 12 months. So you're looking back at how the company did in the past year. But looking forward, there's also a different PE ratio you can look at. So this, I'm just using Yahoo Finance's free website, and you can find this kind of information on the companies with any broker or any investment website that you can find. All of this information is free to the public. You'll see that looking at under Apple statistics, right here, you'll see here's the PE, trailing PE. So again, that's the trailing 12 months, the PE ratio for the past 12 months. And down here, you have the forward PE. The forward PE is what analysts expect the company to be worth in the next 12 months. So it's looking forward. The problem with the forward-looking PE and trying to judge if the price of the share is expensive or not is that the forward PE are guesses from analysts, and analysts actually have a very bad track record of guessing correctly. In economics and finance classes, your professor, your teacher probably tell you that the markets are efficient and so everything is priced exactly as they should be, and therefore it's really hard to make money from it. But that's not true, because it's all based on a lot of these analysts that are analyzing things that are kind of disconnected from reality, which is why you often have news like this. A company reports its earnings, you'll get things like a surprise. Target keeps earnings surprise alive. There's an earnings surprise because the analyst gets wrong. Sometimes a company will miss its earnings expectations. So like in this headline, Facebook earnings miss. However, the stock is up. So again, the stock isn't really connected with how the company itself is doing. A lot of times there's that multiple expansion or there's that multiple contraction. And all of this, especially the forward PE, is based on analysts' guesses. And so they're guessing on what the earnings would be because the earnings haven't happened yet. And they're also guessing on the multiple, which hasn't happened yet. So all of that makes for a lot of uncertainties in just using the stock price to kind of predict how the company is going to do. I actually learned this the hard way. Back in 2008, I had just gotten started in the stock market, and I was hired as an engineering analyst for a hedge fund, and I was sent to the Merrill Lynch headquarters in New York during the financial crisis. It was the day when Merrill Lynch went bankrupt and had to be sold to Bank of America to keep Merrill Lynch alive. I was there on that day right here, and then the financial crisis continued and we went down, so much more after that. So I was there on Merrill Lynch on that day. I was at an energy conference with a bunch of CEOs of all the big energy companies in the US, and they were talking to a bunch of analysts, including me, from hedge funds and big investment banks. And what I noticed was all the analysts were still thinking that their estimates would be right. Their hubris, their ego kind of thought that, company prices should still be back up here. But instead, we were going through this crash, things were falling apart. And they kind of had this disconnect because they're so focused on analyzing just what the companies are doing. They don't understand how the stock price would move. And for those of us that are individual investors, it's the actual price of the stock is where we can sell it or buy it at. It doesn't really matter what the company is worth or what the company should be worth. It only matters what the price of the stock actually is and where the price of the stock actually goes, because that's what we're buying and selling. It's the price of the stock, where if we sell it, then we can go spend it on, buying a house or using it for retirement or using it to go on a trip. But talking about what a company should be worth is what analysts do.
What? No. I can't go to Yemen.
Why not?
I'm an analyst. I don't interrogate people, I write reports.
That's why since 2008, since that conference, that was a turning point where I just stopped dealing with trying to think too much about how the company is doing, and I would just focus on stock charts and analyzing how the price of the stock is doing, because that's in the end, that's what I pay if I'm trying to invest in something, and that's also what I sell it for, is the price of the stock. What happens when a company doesn't make any earnings? Yes, that actually happens for a lot of stocks, a lot of big companies that you see, including Tesla, and also like newer companies like this one, Beyond Meat. These companies lose money every quarter, every year. A lot of these companies lose billions of dollars every year, and yet their stock prices are very high. So how do you estimate how much a company is worth when it's sort of in the startup phase where it's not making any money, but you kind of hope it would have earnings in the future? Down here, it's EPS. Let me zoom in. So this is the Beyond Meat chart. And as you can see, for Beyond Meat, its earnings per share is negative 29 cents. And therefore, because it has negative earnings, it doesn't really have a PE ratio. So the PE ratio right here says not available. How do you analyze a company? How do you value a company when there are no PE ratios? Well, looking here at, again, using Yahoo Finance and looking at the stats of Beyond Meat stock, you can see it does have a forward PE, which is still very expensive. You see how the forward PE right here is $169. So you're paying $169 per dollars of future earnings that analysts are expecting. So it hasn't made that money yet. It's just expecting to make that dollar, and then you would pay 170 times, 169 times for that future dollar of earnings. Another better way to analyze a company that doesn't have any earnings is you can look at the price to sales. That's also a multiple. Instead of price to earnings, which is the PE, now you have price to sales right here. And price to sales, then you can look at the past 12 months as these companies have been open. As long as these companies have been open for 12 months, and they'll have sales, hopefully. And for Beyond Meat, using its price to sales numbers, the current price to sales number is 10.8. So that seems a little bit more reasonable. You're just hoping that at least it's selling its products, and hopefully eventually the management will figure out how to lower the costs or how to increase the sales to cover all the costs so that the company actually makes money, and then so you as an investor would make some money. because right now these newer companies are actually losing a lot of money. They're just spending money on advertising. They're spending money on hiring people. So these companies have negative earnings. Again, my name is Jeffrey Lin for Stock Sessions. Hope you found this video helpful. Please smash the like button, hit the subscribe button, and leave a comment below. Let me know what other videos you guys want to see, what topics you want to learn more about, or what questions you want to have clarified. Thanks.